What will investment fund managers be buying in 2021? I spotted an interesting article on Reuters which looks at the 5 trades the world's biggest investment houses seem to agree on this year. I'll link to that article in the description. In this video, a look at these 5 consensus trades and what I think about each theme. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice. On this channel I talk about personal finance, investing and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, click on that little red subscribe button to become part of our subscriber community. It's completely free and you'll never miss an episode. According to this article from Reuters, consensus amongst the largest fund managers in the world includes dumping the US dollar, buying emerging markets, and sustainable investment, good old ESG again. As we start 2021, everyone seems to be pinning their hopes on vaccines as a route out of this pandemic and a path towards economic recovery. Before I get into this video, it's worth keeping in mind that 2020 was a decent year for global stock markets as long as we leave aside the FTSE 100 index. But the pandemic has changed things, or at least the pandemic has acted as a catalyst for speeding up existing changes to how we live, how we use different businesses. The first consensus trade, according to Reuters, is the mighty US dollar falling. They say that COVID-19 ended a decade of US dollar strength, with forecasts in 2021 of more pitfalls for the greenback. According to an investor survey at Bank of America in December, shorting the dollar was the second most crowded trade. Another reason for expecting the dollar to struggle this year is the US Commodity Futures Trading Commission data showing that $30 billion worth of net dollar shorts. That's compared to $17 billion worth of net long last December. That is a big swing towards traders shorting the US dollar and indicates tough times ahead for the currency. Reuters share a comment from Peter Fitzgerald, who is Chief Investment Officer for Multi-Asset and Macro at Aviva Investors. He said that no central bank can outdove the Fed. Because the US Federal Reserve has cut interest rates close to zero, it's removed the dollar's yield advantage over its peers, and the Fed still has some room to further ease its monetary policy. With Donald Trump about to exit the White House, there could be fewer trade and political tensions under a Joe Biden administration, removing that particular type of support for the US dollar too. There's also history showing us that the dollar tends to decline after deep recessions, with 5 instances of 8 to 10% annual depreciation recorded between 2003 and 2018. Investment manager PIMCO thinks that the rollout of the vaccination program worldwide and also rebounding economies in emerging markets will both serve to hasten the dollar's fall from grace. There's a lot of logic behind this forecast and historic factors seem to back it up too. I don't want to fuel any conspiracy theories here, but we often hear about the US dollar being replaced soon as the global reserve currency. There could be some tough times ahead for the greenback. Consensus number 2 is re-emerging markets. According to Morgan Stanley, emerging markets should benefit from recovering global trade, tourism and commodities, as well as a weaker US dollar and a more stable, predictable White House. Let's face it, anything is more stable than the stable genius himself, President Trump. According to this article, Morgan Stanley is recommending currencies from China, Mexico, Brazil, South Africa and Russia, alongside bonds from the Ukraine and Mexican oil firm Pemex. There's support for this view from Goldman Sachs and JP Morgan, who are also backing emerging markets in 2021. And Bank of America, their investor survey showed emerging markets as the favourite sector, with an overweight allocation by investors. Bank of America also expects debt in emerging market currencies to net investors 6.2% during the next year, yielding more than the S&P 500 index. There are some headwinds to consider too. Citi thinks that higher Treasury yields could prompt a 2013-style temper tantrum, and also points at the risk of bond defaults in weaker nations. Emerging markets do seem poised for a decent recovery this year, assuming the global economy gets moving again, and that will rely to a large extent on the speed and effectiveness of the vaccine rollout. Keep in mind that emerging market equities and bonds are typically more volatile than those from more established economies, and that higher risk does come with the potential for greater rewards, but also, of course, the higher risk of loss. So do take care when it comes to allocating your portfolio to that particular sector. Theme number 3 is central banking on it. Nothing in life is certain but death, taxes, and central banks printing cheap money. According to Reuters, the consensus from global fund managers is that the Federal Reserve, European Central Bank, Bank of Japan, Bank of England, and the People's Bank of China will keep the money presses printing in 2021, and I think that's a very safe bet. According to the Bank of America, central banks have spent £1.3 billion an hour since March, since the onset of the pandemic, buying up assets as part of their quantitative easing programs. They've also cut interest rates 190 times between them in 2020. That's roughly 4 rate cuts for every 5 trading days. One headwind for further monetary easing this year is growth in global GDP, expected to rise this year by 5.4%, and therefore the risk of rising price inflation. And there might not be much headroom left for further monetary easing anyway. JP Morgan says that more than 80% of sovereign bonds issued by richer countries pay a negative yield once inflation is factored in. Many investors are currently underweight sovereign debt as a result, but the big 5 central banks should buy $3 trillion worth of bonds this year. That is lower than the $8 trillion printed by central banks to buy bonds in 2020, but it should still be sufficient to keep bond yields incredibly low. In the article, JP Morgan cautions that consensus forecasts about the direction of Treasury yields during the past 10 to 15 years only got it right about 40% of the time. And I can remember a period of years in recent years where fund managers were consistently saying that bond yields would start to rise, and therefore bonds were a very risky asset. And of course, that belief, that forecast, never came to fruition. The consensus isn't always right. Consensus number 4, ESG is here for good. ESG, or environmental, social and corporate governance, is an invest in mega theme right now. Allocations to ESG investments are surging, doubling in the past 12 months. We're seeing a green agenda from governments across the world, with newly elected US President Joe Biden committing to re-enter the Paris Climate Change Agreement as his first act in the White House. In the Reuters article, BlackRock calls ESG the tectonic shift transforming investing and forecasts persistent flows into sustainable assets in the long transition to a less carbon-intensive world. The article notes that 2/3 of ESG fund assets are in equities, but sustainable debt has grown by 20% in the past year to reach $620 billion. More governments are issuing green bonds, and central banks are likely to step up their asset purchases of more sustainable bond buying. There's no doubt in my mind that ESG investing is here to stay and will continue to grow in popularity. I've got some reservations about ESG, and we see a great deal of greenwashing taking place out there to make investment funds look more ethical, more sustainable than they might realistically be. ESG is also often at odds with index fund investing, although index fund managers are getting better at passing their proxy votes over to activists. And then consensus theme number 5, Biden calling time on tech. There is little doubt that President Biden will shake things up over the next 4 years. He's set to have a very different presidency to the incumbent. According to Bank of America, there's a risk that China, North Korea, or Iran might look to test Biden early on in his presidency, so keep an eye out for any provocative actions from those nations. But when it comes to tech, which was such a runaway performer in 2020, how will Biden influence the markets? The Reuters article suggests that Biden might be just as testy as Trump when it comes to big data, 5G, artificial intelligence, electric vehicles, robotics, and cyber security. Because tech and e-commerce businesses account for almost a quarter of US corporate profits and 40% of the market cap of the MSCI Emerging Equity Index, then Biden's stance on tech could have significant implications for equity markets in the coming years. So let's watch this space on that particular theme. So there you have it, 5 consensus themes from fund managers, from global fund managers, as we start 2021. I'll link to the Reuters article in the descriptions. There's some interesting graphs and charts in that too. What do you make of these calls? What impact will they have, if any, on how you position your portfolio in the years ahead? Before I wrap up this video, a note of caution: nobody can predict the future. Not me, not you, not investment fund managers. It's interesting to talk about this stuff, but we know as financial planners that the best results don't come come from crystal ball gazing, but instead they come from the consistent application of a robust investment strategy. I hope you found this video helpful. There is one super quick thing you can do right this second to support this channel. Smash the like button. In fact, which finger do you use to smash the like button? Do you use your sort of index finger? Try using a different one today, just see how it feels. If you fancy being an even bigger supporter of this channel, why not share this video with your social network or with a friend who you think might get something out of it? Press that share button now. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.